Welcome to our video on the 7 rules you only need to know when investing, inspired by the investment philosophy of one of the greatest investors of all time, Warren Buffett. With decades of experience and an enviable track record, Warren Buffett has been an inspiration to millions of investors around the world. In this video, we will be discussing the 7 investment rules that have guided Warren Buffett's success and can help you achieve your investment goals too. If you like our content, you can subscribe to our channel to be alerted every time we upload a new video. Also, you can like and comment the video with all the questions you might have. Now let's get started. Rule number 1. Invest in what you understand. This is perhaps the most important rule of all. Don't invest in things you don't understand. Stick to what you know and invest in companies that you believe in and that have a clear business model. One of the biggest mistakes that new investors make is investing in something that they don't understand. It's important to remember that investing is not about gambling or taking a chance on something that you don't fully comprehend. When you invest in something you understand, you are better equipped to make informed decisions about the company's future prospects and potential for growth. For example, if you work in the tech industry and have a deep understanding of the latest trends and emerging technologies, you may want to consider investing in companies in that sector. By investing in what you understand, you can make better decisions and minimize your risk. Rule number 2. Have a long-term perspective. Successful investing is a marathon, not a sprint. Don't be swayed by short-term fluctuations in the market. Instead, focus on the long-term prospects of the companies you're investing in. It's easy to get caught up in the daily ups and downs of the stock market. However, focusing too much on short-term gains or losses can be detrimental to your long-term investment goals. When you invest in a company, you should be thinking about the next 10, 20, or even 30 years. It's important to remember that investing is not a get-rich-quick scheme. It takes time, patience, and discipline to achieve long-term success. By having a long-term perspective, you can weather short-term market fluctuations and focus on the big picture. Rule number 3. Buy quality companies. When investing, focus on quality over quantity. Invest in companies that have a strong competitive advantage, a proven track record of success, and a management team that you trust. One of the keys to successful investing is to focus on quality companies. These are companies that have a strong competitive advantage, a proven track record of success, and a management team that you trust. Investing in high-quality companies is important because they are more likely to weather economic downturns and emerge stronger on the other side. It's important to do your due diligence before investing in a company. Look for companies that have a strong brand, a loyal customer base, and a solid financial track record. By investing in high-quality companies, you can minimize your risk and maximize your returns over the long term. Rule number 4. Don't overpay. Even the best companies can be a bad investment if you overpay for them. Be patient and wait for the right price before investing in a company. Another common mistake that new investors make is overpaying for a company. Even the best companies can be a bad investment if you pay too much for them. It's important to wait for the right price before investing in a company. Rule number 5. Focus on cash flow. One of the most important things to look at when investing in a company is its cash flow. Cash flow is the lifeblood of any business, and companies with strong cash flows are better equipped to weather economic downturns and invest in future growth. When you invest in a company, it's important to look at its free cash flow. This is the cash that a company generates after it has paid all of its expenses, including capital expenditures. Companies with strong free cash flows are in a better position to reward shareholders through dividends and share buybacks. Rule number 6. Be patient. Patience is a key ingredient to successful investing. Don't be swayed by short-term market fluctuations, and be prepared to hold on to your investments for the long haul. Investing can be a roller coaster ride. The market can be unpredictable and volatile, and it's easy to get caught up in the excitement of short-term gains or losses. However, successful investors know that patience is key. Don't be swayed by short-term market fluctuations, and be prepared to hold on to your investments for the long haul. This means resisting the urge to sell when the market is down and avoiding the temptation to jump into the latest hot stock. By being patient, you can give your investments the time they need to grow and prosper. Rule number 7. Stay humble. Finally, it's important to stay humble when investing. No one has all the answers, and even the best investors make mistakes. The key is to learn from those mistakes and use them to become a better investor in the future. Investing is a lifelong learning process, and even the most successful investors make mistakes. The key is to stay humble and to be open to learning from your mistakes. Don't be afraid to admit when you're wrong, and be willing to adjust your investment strategy as needed. Thank you for watching our video on the 7 investment rules you only need to know when investing, inspired by Warren Buffett's investment philosophy. By investing in what you understand, having a long-term perspective, buying quality companies, avoiding overpaying, focusing on cash flow, being patient, and staying humble, you can become a successful investor too. Remember to always do your due diligence, consult with a financial advisor, and invest in a way that is aligned with your risk tolerance and investment goals. Happy investing!